We think that the interest rate environment is driving a change in the global investment opportunity set that feeds through into fixed income, but also currencies and equities. So we're in a regime shift, if you like, as central banks look to exit close to a decade of very accommodative monetary policy. And we think that leads to more disruption in markets, higher levels of volatility, and potentially negative returns for traditional asset classes. So from a fixed income perspective, specifically, we've been short duration, particularly in the US, for a lot of this year that has been profitable for us. And in Europe, we've typically been either flat, sometimes long, sometimes short duration, depending upon the pattern of markets. We'll trade based on a number of factors. So one of the things that we'll be looking at is momentum in fixed income markets, and that's led us to be short duration in the US, for example, in the 5-year sector, and particularly in short-term interest rates. We'll also look at cross-asset class relationships, for example, the relationships between currencies and interest rates, or long-term yields and short-term rates, and that will drive positioning in fixed income, but also currencies. So we have been short the euro on quite a substantial basis for the last few months, and that's been quite a profitable position for the fund. And we've been long the US dollar generally against a basket of both developed market and emerging market currencies. And from an equity perspective, we've been largely flat, looking to make money more from relative value than from directional positioning. Tend to emphasize as much diversification as possible. So in our portfolio today, we have risk allocated to 5 very different trading strategies. And so we're quite active in trading in all of equities, currencies, fixed income and short-term interest rates. And we try to make sure that we have a number of very different styles, time horizons, inputs and asset class focus. And so we don't have one big bet in any particular area. We tend to have hundreds or potentially thousands of small bets spread across different asset classes and spread across different time horizons. So some strategies will try to make money hour to hour, day to day. Some will have a time horizon of a week to 2 weeks. Some will have a time horizon of a month, and some will have a time horizon of longer term. Some will be more relative value oriented. Some will be more directional. Some will take their positions more from movements in price and volume and derivatives of those numbers, and others will take positions based more on fundamental economic information or corporate information. And so the asset allocation is really about trying to make sure that we've got exposure to a number of different styles and strategies that can work in different environments. And in any given moment, some of those will work and some of those will probably find it more difficult. But over time, the way the portfolio has worked, at least so far, we tend to find 3 or 4 strategies work in a given month and 1 or 2 strategies are negative. And over time, that leads to a general positive return in any environment. We actually weathered that move relatively well. So the portfolio was profitable in January when markets rallied, but we also made money in February when markets fell. And so having a relatively equal risk weighting actually worked quite well through both months. Different things worked in January and February. So in February, global macro was a profitable trading strategy, being long dollar. Short-term trading was profitable because there we were able to short equities quite quickly as equities started to move down, whereas January was more profitable in strategies like trend following, for example. And so year to date, the portfolio has functioned largely as we've expected, and it is built to try and survive different opportunities. So we haven't actually had to adjust positioning very much. The only significant shift in positioning over the last couple of months has been that we remain quite long dollars in the global macro strategy, but with the recent rally in dollars, our trend following strategy that looks in momentum in markets has also become quite long dollars. So to avoid having an overly concentrated long dollar bet in the portfolio, we've reduced our exposure a little bit to those areas. Yes, I think it's very difficult to time markets. So we can observe, on a long-term basis that equity valuations appear high or fairly valued depending on which metric you use. It seems unlikely that equities can continue to deliver the type of returns that they've delivered over the last 7 or 8 years. Fixed income markets, I believe, are challenged in terms of sovereigns by the fact that all of the liquidity that's been pumped in over the last 6 or 7 years is starting to be pulled out now, and yields remain extremely low. So it seems from a risk-reward perspective, fixed income is relatively unappealing and comes with a lot of duration risk. And credit markets are quite tight with interest rates starting to move up. And so it seems sensible to try to find alternative sources of return. But a lot of alternative product hasn't necessarily functioned very well in difficult times. So I think you need to look quite carefully at what kind of alternative product you're buying, what its sources of return are, why it's going to be differentiated from traditional risk premia like equities and duration, and what you're paying for any alpha that's delivered. And so we try to focus quite carefully on those things in our fund to make sure that we can try to get the outcome that people looking for genuine diversification are targeting.